Walmart just crushed their earnings, but the real story is a multi-billion-dollar government tariff refund they're about to weaponize against every other retailer out there. Welcome to Earnings Unscripted, the podcast where we find the actual signal in the noise. Today is August 20th, 2026, and we're unpacking Walmart, ticker WMT, and their fiscal second quarter results.
It's truly an incredible accounting story. On paper, it looked like a pristine quarter. Adjusted EPS hit 81 cents, comfortably beating estimates, and total revenue grew roughly 6% year over year. But you look at the immediate tape, and traders absolutely dumped the stock.
Yeah. Shares completely fell off a cliff in the pre-market and finished the day down nearly 9%, which feels incredibly harsh for a solid top-line beat. And naturally, since we're going to be second-guessing the market's sanity here, please remember our conversation is strictly for entertainment and not personalized investment advice. But Miro, what exactly spooked the big money?
It comes down to how distorted that profit margin actually was. Operating income rocketed up almost 29%, but management openly admitted a massive chunk of that leap was just them finally recognizing those old eligible tariff refunds. The cash flow didn't exactly mirror that profit pop.
Okay, wait. Let me process that. So they basically got a giant delayed tax return from the government, and that's the only reason their bottom line looks so healthy?
Well, no, that's not quite it. The core retail engine is still highly functional and growing, especially in the higher margin e-commerce and ads divisions. But that specific government cash injection completely warped the quarter comparison. Without it, their margins look significantly thinner. And the real issue for Wall Street is what Walmart plans to do with that windfall right now.
Right, because instead of just letting that cash drop to the balance sheet to keep shareholders happy, they're aggressively rolling it back into massive consumer price cuts for the second half of the year. I mean, they were bragging on the call about selling a full week of high-protein school lunches for under $2 total.
Exactly. It's fantastic for inflation-crushed consumers, but terrifying for competitors. They're taking a one-time accounting windfall and using it to deliberately buy market share.
Honestly, good luck to anyone trying to compete against that kind of budget basket. But before we get totally lost in the grocery wars, I want to look at what you found in their corporate expenses, because there's this weird dynamic where they finally solved their employee turnover problem, and it's somehow financially punishing them. I need you to explain why better retention is suddenly an overhead risk.
It's the ultimate corporate paradox, honestly. So Walmart self-insures its employee health care. Usually retail has massive turnover, right? A huge chunk of the workforce never stays long enough to even enroll in the benefits plan.
Oh, okay. So because they fixed the culture and people aren't quitting, suddenly everyone wants the benefits package and their insurance premiums are skyrocketing?
No, not the premiums. That's the catch with being self-insured. Walmart is the one actually paying out the medical claims. It's not an insurance company taking a fixed cut. It's just raw expenses hitting their selling, general, and administrative line directly. Rainey was actually pretty transparent about it on the call.
What'd he say?
I have the exact phrasing here. He said, "Our attrition has gone down quite appreciably." By the way, this is a really good thing. But with attrition going down, the number of enrollees in that plan has increased.
That's just wild. You successfully stopped the bleeding on labor costs, and your reward is a huge spike in medical liabilities.
Right, but it's a trade-off they're perfectly fine making because the underlying operational execution is just ruthless right now, especially when you look at how they're handling their delivery networks.
Yeah, which was the other big surprise. E-commerce profitability improved because for the longest time, dropping groceries on a porch was basically a license to light cash on fire.
It still is for most of the industry, but Walmart found a way out. They pushed store-fulfilled rapid deliveries hard, and this quarter, 37% of those drops were fee-based fast deliveries.
Wait, so instead of just using standard free shipping, customers are explicitly paying an extra fee just to get their items in under an hour?
Exactly. And the strategy runs much deeper than just covering fuel costs. Further argued that speed isn't just logistics anymore. It's actually an acquisition channel.
I'm not sure I follow that. How does a fast delivery acquire a customer?
Well, it's actually, look at the behavior loop.
They noticed that once a customer tries the rapid delivery, they start shopping more frequently overall, and eventually they're much more likely to convert into paid Walmart Plus members.
Okay, I see. You trap them with convenience.
Pretty much. You take what used to be a logistics nightmare and turn it into recurring subscription revenue. It's completely shifting their margin profile. Their U.S. marketplace volume surged 52% year over year, and global advertising jumped 38%.
So the physical store isn't really just a store anymore. It's a local warehouse using cheap groceries to drive traffic, while the actual profit engine is the ad network and the delivery fees layered on top.
It's the omni-channel holy grail. And they're subsidizing it all heavily through supply chain investments. Over 3,100 U.S. stores are processing automated freight now. The U.S. e-commerce business actually hit double-digit incremental margins because of it.
That's a staggering footprint for automation. But, if they're throwing all this capital at robotics and paying out all these extra healthcare claims, how does that square with their actual cash flow underneath that massive tariff refund?
Well, that's exactly why Wall Street panicked this morning. If you strip out that massive accounting benefit, their free cash flow actually dropped by over $1 billion compared to last year. It looks a lot more fragile when you realize they raised full-year capital expenditure expectations up to 4% in net sales.
So they're building out this high-tech fulfillment utopia, but the actual free cash flow is feeling the squeeze. That's a ton of pressure on management to prove this automation pays off before depreciation eats their margins.
Right, but management isn't acting worried. They actually raised full-year guidance across the board. They now expect net sales growth somewhere between 4 and 5%. Though they did warn that next quarter's top line takes a temporary hit, mostly because Flipkart's big annual sales event is shifting later into the winter.
Oh, the big billion days shift. That's just a calendar quirk, so I doubt the market cares too much. But I'm curious about those new pharmacy regulations they flagged. The maximum fair price cap, didn't that create a pretty massive headwind for U.S. sales?
It did. It dragged down U.S. comparable sales by a full 125 basis points this quarter. But here's the paradox. They claim the underlying profit contribution from health and wellness is completely fine.
Wait, how does that work? You lose that much top-line revenue to drug deflation, but keep the profits?
Because pharmacy delivery shoppers are incredibly lucrative. Once a health and wellness customer starts using delivery, their overall spending almost doubles. So they're essentially using cheaper, heavily regulated prescriptions to pull people into the app and cross-sell high-margin apparel and home goods right into the basket.
Which loops right back to the entire Walmart thesis right now. Subsidize the front door, make the real money on the back-end network. It's going to be fascinating to see if they can maintain this balancing act through the holidays or if the sheer weight of physical capital costs finally catches up with them. We'll definitely be watching.
Always a pleasure. Catch you next time.
If you'd like our next episode waiting for you, just tap follow in your player. As a quick transparency note, this entire show's fully AI generated, voices and script included. And that's how we're able to digest Walmart's massive earnings call and get it into your feed the very same day. We'd love to hear what you're watching, so send those ticker requests over to earningsunscripted@datamadness.ca or use the X link in the show notes. See you soon.
Take care.